So how does a Wall Street darling, this hyper-growth energy drink company that completely disrupted the entire beverage industry, somehow grow its total revenue to over $800 million in a single quarter?
Right. Well, at the exact same time, they're watching their core namesake brand literally shrink by 12%.
Exactly. I mean, it creates this massive cognitive dissonance for anyone actually looking at the balance sheet.
Oh, absolutely. You have this huge top-line number that looks like a victory on paper, but the foundation it was built on appears to be sort of crumbling in real time.
Yeah, it is the ultimate diagnostic puzzle. And welcome, everyone, to this Talk Tickers Deep Dive. Our mission today is highly specific, and for those of you holding this stock, well, it's incredibly urgent.
Yeah, we are breaking down the Q2 2026 earnings call for Celsius Holdings, trading under the ticker symbol CELH.
Right, and the goal here is to just, cut through the corporate spin. We're going to ignore the polite euphemisms and extract the absolute actionable insights that you need as a retail investor.
Because when a company that the market has historically treated like this flawless growth engine suddenly reports numbers that require like a heavy amount of footnotes and caveats to understand, the narrative gets incredibly noisy.
Oh, it gets so noisy. I mean, the institutional analysts on this call were clearly struggling to reconcile the long-term vision with the immediate short-term carnage in the core brand.
Yeah, and that tension is exactly what we are going to explore today. This is going to be a data-forward, no-fluff analysis.
We've got the full transcript featuring CEO John Fieldly and CFO Jared Langens, and we're going to dissect the physical mechanics of what actually happened this quarter.
Because honestly, this isn't just a story about a single quarter's earnings. I mean, this transcript is a real-time case study in the agonizing growing pains of a beverage company.
Right, they're transitioning from this scrappy, throw-everything-at-the-wall challenger brand into a mature national powerhouse managing a really complex portfolio.
And to understand the sheer scale of the disruption, we really have to contextualize where Celsius came from. Like if you rewind just a few years, the energy drink landscape was entirely dominated by legacy giants.
Right, you had Monster and Red Bull controlling the overwhelming majority of the market share.
Exactly. And they built their empires on a very specific demographic, heavily male action sports, gaming, and just extreme caffeine consumption.
Yeah, and then you had that disruptive wave of brands like Bang, which pushed the caffeine content even higher and marketed heavily on social media.
But they ultimately suffered a spectacular crash, right? Due to, legal battles and massive distribution failures.
Right, and Celsius entered this arena with a completely different playbook. I mean, They executed a classic blue ocean strategy.
Yeah, they didn't try to out Monster. They pivoted hard into the better-for-you performance energy space.
Exactly. They targeted the fitness demographic, the yoga studios, the run clubs. They adopted that sleek 12-ounce can that felt more like a premium health and wellness product.
Rather than a traditional, aggressive energy drink.
Right.
And that differentiation allowed them to capture an entirely new consumer base.
People who had historically just ignored the energy drink aisle altogether. I mean, they expanded the total addressable market.
And that unique positioning is what fueled their hyper-growth phase. It took them from a niche brand to a multi-billion-dollar valuation.
Right, and eventually secured them that massive distribution partnership with PepsiCo. But hypergrowth is a double-edged sword.
It really is. When your stock is priced for perfection, the market expects you to deliver flawless execution, literally quarter after quarter.
Exactly. So let's pull the Band-Aid off. Let's look at the actual Q2 numbers that sent these shockwaves through the market.
Okay, so the headline portfolio revenue for Celsius Holdings in Q2 2026 came in at $818 million. On paper, that is up 11% year over year.
Yeah, I have to stop you there because for a retail investor who has been following this story, 11% growth feels incredibly pedestrian.
Oh, totally. I mean, we were talking about a brand that was routinely posting double-digit, sometimes triple-digit growth metrics in its prime.
Right, taking massive outsized bites of market share from those legacy players. So seeing a mere 11% growth across the whole portfolio sets off immediate alarm bells.
Yeah, it signals that the era of effortless, hyper-accelerated expansion might actually be over.
Because when you are priced at a premium multiple, low double-digit growth is routinely punished by the market as a failure.
Exactly. The algorithmic trading models are designed to aggressively sell off any stock that shows deceleration regardless of the absolute revenue dollar amount.
But the $818 million top-line figure isn't even the most startling metric in this report. I mean, the profitability profile is where the real structural changes are happening.
Yeah, adjusted EBITDA dropped to $184 million this quarter.
Which is wild, because a year ago, in the exact same quarter, adjusted EBITDA was $210 million.
Right. So revenue goes up to $818 million, meaning they sold 11% more product in terms of dollar value, but their operating profit actually shrank by $26 million.
That is a fundamental disconnect. Selling more volume while making less money implies a severe margin compression.
And the margin profile absolutely took a hit. Adjusted EBITDA as a percentage of revenue fell to 22.5% this quarter. Last year, it was pushing closer to 28%.
Wow. So did management point to any specific pressures causing this profit squeeze?
They did. They cited a few very specific, highly technical pressures. First, they talked about a challenging macro commodity environment, primarily the cost of aluminum.
Okay, let's dive into the mechanics of that, because I know it's not as simple as the price of cans going up at the local supplier.
No, not at all. Beverage companies of this scale operate on really complex commodity hedging strategies.
Right, they buy aluminum futures contracts months or even years in advance to lock in their costs.
Exactly. It protects their margins from spot market volatility. But when a company is in a hyper-growth phase, forecasting exactly how much aluminum they will need is incredibly difficult.
Because if you underhedge and you suddenly need millions of additional cans to meet unexpected consumer demand, you're in trouble.
Yeah, you are forced to buy that aluminum on the spot market. And if the spot market is experiencing inflation, which it has been, driven by global supply chain constraints and energy costs, you pay a massive premium.
And fractions of a cent per can, multiplied across hundreds of millions of units, will instantly vaporize your operating profit.
Exactly. Management did note, though, that improvements in outbound freight helped offset some of that aluminum inflation.
Right, which allowed them to hold gross margins relatively steady at about 48%, consistent with the first quarter.
Yeah, outbound freight has normalized significantly since the pandemic-era supply chain crisis, so it's acting as a minor shock absorber for the commodity hits.
But the other massive drag on profitability was increased operational investment, right? I mean, they are pouring capital into trade and promotional spend.
Oh, heavily. They're investing in marketing for the summer selling season, and they are aggressively expanding their physical sales force.
Yeah, they cited the addition of hundreds of retail merchandisers and sales representatives. This represents a deliberate, painful shift in their business model.
It really does. During their hypergrowth phase, the organic pull from consumers was so strong that the product practically sold itself.
Retailers were desperate to get it on the shelf. But as the market matures and legacy players fight back, Celsius is transitioning into a highly capital-intensive model.
Yeah, it's essentially operational trench warfare.
So what does that trench warfare actually look like on the ground for them?
Well, it means physical human beings driving to grocery stores, negotiating with store managers, setting up cardboard displays.
Literally physically moving cans from the back stockroom to the front coolers. It means fighting for inches of premium, eye-level shelf space.
Exactly. Against Monster and Red Bull representatives who are doing the exact same thing. And that requires boots on the ground.
And a massive payroll expansion like that structurally lowers your operating margin.
Yeah, it is the cost of defending your territory in a mature market. But, the most fascinating revelation from this earnings call isn't actually the margin compression.
Oh, really? What is it then?
It's the composition of that 11% top-line growth. Because when we actually unpack the $818 million revenue figure, we see a tale of two entirely different brands.
Right, just hiding inside that single number. This is where the narrative shifts dramatically for them.
Yeah, Celsius Holdings is no longer just Celsius. They have evolved into a portfolio company.
And when you peel back the layers of that 11% overall growth, you find a startling reality.
You do. The core namesake Celsius brand, the revolutionary performance energy drink that built this entire multi-billion-dollar empire, actually saw its net sales drop 12% year over year.
The core engine is going backward. So the obvious question for you becomes, if the core brand is shrinking by 12%, How on earth did the total company grow by 11%?
The entire growth of the company, literally the only thing keeping this earnings report from being an absolute bloodbath, was carried squarely on the back of their recent acquisition.
Alani Nu.
Exactly. Alani Nu is currently the hypercharged V8 engine pulling the entire corporate train forward right now.
I mean, they posted $364 million in net sales for the quarter. That is a massive 21% increase year over year.
It's huge. Furthermore, management announced that Alani Nu officially crossed the $1 billion mark in retail sales for the first half of the year in tracked channels.
Wow. And then to round out the portfolio, Rockstar, the other brand they integrated into their platform, added $66 million in net sales.
So we are looking at an acquired brand completely masking a significant stumble in the legacy core brand.
But on paper, the portfolio strategy makes perfect sense. These three brands are heavily segmented.
Yeah, they serve entirely different demographics, which prevents them from cannibalizing each other on the shelf.
And management was very explicit about this bracketing strategy on the call, weren't they?
They were. They described Celsius as the performance brand, targeting a mindset of active living.
Right. It isn't tied to a specific sport or age bracket. It's tied to daily movement, gym culture, health-conscious consumers.
Then they contrast that with Alani Nu, which they say wins on flavor and self-expression. Alani Nu heavily recruits younger, more female consumers.
Yeah, and management pointed out a crucial psychological metric there. For many of these younger female consumers, Alani Nu is the very first energy brand they ever try.
Exactly. It acts as the gateway into the entire energy drink category for them. And the strategic value of capturing a consumer at the entry point cannot be overstated.
Because legacy energy drinks historically alienated this demographic, right?
Right.
With hyper-aggressive marketing, dark packaging, harsh flavor profiles.
Right, whereas Alani Nu uses bright pastel branding and highly accessible, almost candy-like flavors.
And if you become a consumer's baseline for what an energy drink should taste and feel like, you build a massive moat of brand loyalty.
Exactly. And then, on the complete opposite end of the spectrum, they have Rockstar.
Right. Management described Rockstar as reaching the top of the category. A distinctly male consumer with a deep affinity for gaming, action sports, high-energy music occasions.
They explicitly stated that Rockstar has a 25-year history and heritage that gives it permission to play in spaces where Celsius and Alani Nu simply do not naturally fit.
Yeah, I mean, a gamer drinking a Celsius feels a bit incongruous, but a gamer drinking a Rockstar feels authentic.
So you bracket the market perfectly. Celsius captures the fitness crowd, Alani Nu captures the young female entry demographic, and Rockstar captures the traditional male action sports consumer.
It is a beautiful theoretical architecture. But theory is one thing, and the Q2 numbers are the harsh reality.
Right.
Because the core brand is down 12%. So we have to ask the most important question of this entire deep dive. What exactly went wrong with the core Celsius product? Where did the cans go?
Well, to understand the 12% drop in core Celsius sales, we really have to translate a very specific piece of supply chain jargon that management repeated throughout the call.
And what was that?
SKU rationalization and inventory rebalancing.
Okay, let's break down the mechanics of a SKU rationalization for you. In plain language, Celsius decided to kill off a massive number of their underperforming or niche flavors.
Exactly. And they did this intentionally to try and make physical room on the delivery trucks and in the distributor warehouses for their newly acquired brands, Rockstar and Alani Nu.
Because you can't just add two massive brands to a distribution network without displacing something else. The trucks only hold so many pallets.
Right. But they executed this rationalization very aggressively. And during the Q&A portion of the call, the CEO, John Fieldly, essentially admitted it was a severe tactical error.
Yeah, when an analyst pressed him on the execution, Fieldly explicitly stated, "We went too deep on the Celsius rationalization."
He admitted they could have done a much lighter job on it, and in hindsight, he definitely would not have cut as many SKUs through the commercial plans.
I'm going to use a real estate metaphor here to explain exactly why cutting these flavors caused a 12% revenue drop. Think of distributor warehouse space as extremely expensive, highly sought-after commercial real estate.
Okay, I like this.
Celsius, as the landlord, effectively left bad tenants, these unpopular, discontinued flavors, in those warehouse apartments.
Right. When Celsius implemented this heavy SKU rationalization, they told their direct-to-store delivery distributors, primarily the Pepsi network, to stop carrying these flavors.
But the distributors already had thousands of pallets of those discontinued flavors sitting in their warehouses. They had already paid for them.
Exactly. Until those bad tenants move out, meaning until those discontinued flavors are eventually pushed to retail stores and bought by consumers, the distributor is not going to sign a lease for your new fast-moving products.
Right. The space is physically occupied. The distributor refuses to buy any new pallets of core Celsius flavors until they completely burn through the dead inventory you left them stuck with.
And this physical reality creates the most critical data point from the entire call, something the CFO, Jared Langens, spent significant time explaining.
The massive gap between scanner data and shipment data, right?
Yes. If you are a retail investor trying to figure out if a brand is dying or just experiencing a temporary logistical nightmare, this gap is the entire ballgame.
So explain that gap. How does it work?
Well, the CFO explained that retail scanner data, which measures actual consumer purchases at the cash register when the barcode is scanned, showed that consumer purchases of the Celsius brand were only down 2% in the quarter.
Wait, really? So consumers at the register only bought 2% less Celsius?
Exactly. But the company reported that net sales were down 12%.
That is a massive 10% gap. Where did that 10% of revenue go?
Yeah. That 10% gap is the direct result of the wholesale distribution network freezing its orders. Reported net sales are based on shipments, what Celsius sells to the Pepsi distributors, not what the consumer buys at the store.
I see. Because the pipe was clogged with old, rationalized inventory, the distributor stopped ordering new product.
Yes, the flow of wholesale revenue temporarily stopped, even though consumers were still steadily buying the product off the retail shelves.
Right, and the CFO noted that these depletions versus orders accounted for roughly half of that massive gap between scanner data and reported results.
So the pipeline was completely paralyzed, but that wasn't the only operational friction they faced.
No, they also talked about how they used this transition period as an opportunity to secure better retail space, which ironically caused further delays.
Yeah, they weren't just fighting for more shelf space, they were negotiating for what they called the right kind of space.
Meaning cold space, end caps. Permanent branded coolers situated in the highest traffic zones of grocery and convenience stores, like the checkout aisles.
But securing this premium space isn't just a matter of printing a new shelf tag. It requires physical, capital-intensive investment from the retail partners.
Exactly. Grocery stores have to schedule union labor, rip out old shelving, run electrical lines for new coolers, and physically build out the fixtures.
And that level of physical coordination significantly delayed their retail reset periods. The space they were promised took much longer to materialize than they forecasted.
So you have a compounding logistical failure. They cut too many flavors, which clogged the distributor warehouses, which stopped new wholesale orders from flowing in.
Simultaneously, they were waiting on retailers to physically build out premium cooler space, which delayed their visual presence in the store.
And to complicate matters even further, they admitted they purposefully delayed launching any new innovation or core flavors to bridge this gap.
Yeah, they didn't want to overwhelm the Pepsi distribution system with new Celsius products while they were laser-focused on getting Rockstar and Alani New integrated onto the trucks.
Right. They intentionally put the core brand in a holding pattern, assuming it would coast on its momentum. And they dramatically underestimated how punitive that holding pattern would be on their wholesale ordering volume.
But we also have to look at the macro channel dynamics because the CFO mentioned softness in the club channel as a compounding factor.
Yeah, let's unpack the club channel for you because it operates on entirely different financial mechanics than your local convenience store.
Definitely. The club channel represents massive wholesale retailers like Costco or Sam's Club. These environments are defined by ultra-high volume and extremely low margins.
You are selling massive shrink-wrapped flats of 18 or 24 cans.
And from an operational standpoint, the club channel provides incredible leverage. When you secure a massive purchase order from Costco, your manufacturing plants get to run at 100% capacity.
Right, you're pumping out single flavors on massive pallets without having to stop the production line to switch packaging or mix varieties. It is the most efficient, cost-effective way to run a beverage factory.
But operating leverage is a double-edged sword. When consumer offtake at the club level softens even slightly, well, it hits hard.
Yeah, perhaps because consumers are feeling inflationary pressure and hesitate to drop $30 on a bulk case of energy drinks.
Exactly. Costco slows down their massive purchase orders. Suddenly, your manufacturing plants are running at 85% capacity instead of 100%.
And all of those fixed costs, the factory leases, the heavy machinery depreciation, the corporate salaries, now have to be absorbed by a smaller number of units produced.
Your cost per can spikes and your gross margin gets crushed. That is why softness in the club channel cascades backwards so aggressively into the supply chain.
Which is exactly why establishing a dedicated revenue growth management team, which the CFO noted they now have fully in place, is critical for their 2027 strategy.
They have to build sophisticated data models to predict these channel fluctuations. They need to build efficiency back into a system that got heavily disrupted by the portfolio integration.
So the operational picture for the core brand looks incredibly messy in the short term. It is a massive logistical knot.
It really is.
But, and this is a major point of contention for anyone evaluating the stock, there was a very strong capital allocation signal buried in this earnings report that completely contradicts the panic you might feel looking at a 12% revenue drop.
Oh, the buyback. Management announced they bought back $100 million of their own stock in Q2.
Yeah, $100 million. That brings their first half repurchases to approximately $124 million.
And they explicitly stated their intention to fully utilize the remaining authorization of their $300 million stock buyback program.
The CFO, Jared Langens, defended this move by claiming their cash flow return on investment is among the strongest in the beverage category.
Right, and at current price levels, they view repurchasing their own stock as a highly attractive use of capital.
But let's debate this, because there are two wildly different ways to interpret a company buying back its own stock during an operational stumble.
Okay, so the bullish interpretation, the massive confidence signal, is that management is looking at the internal data. They see that consumer scanner sales are only down 2%.
They know the physical inventory clog in the Pepsi network will eventually clear out.
Exactly. They believe the market is wildly overreacting and mispricing the stock based on a temporary wholesale disruption. So they use their massive cash generation to buy the dip.
Essentially betting on themselves and increasing the ownership percentage and earnings per share for the remaining shareholders. It is a flex of financial strength.
I agree. But what's the bearish take?
I'm going to take the other side of that trade. If I am a skeptic, a massive share buyback from a former hypergrowth darling feels like a surrender.
Surrender? How so?
If you truly have endless runway to grow internationally, if you have revolutionary new product lines to launch, shouldn't you be plowing every single spare dollar free cash flow back into marketing, research and development, and aggressive global expansion?
That's a fair point. Buying back stock is typically a mature, dividend-paying legacy company move. It is what IBM does. It is what legacy tobacco companies do.
Right. It is not what a disruptive growth company does. It signals that management has run out of high return ideas for their capital.
And that is the core existential tension for investors evaluating CELH today. Are we looking at a hyper-growth company hitting a temporary logistical snag? Or are we witnessing the permanent maturation of a brand that has finally hit its domestic ceiling?
Although, to be fair to management, if we look at what they are doing with the acquired brands, they're aggressively deploying capital.
Yeah, they completed the Rockstar integration into their platform on an incredibly compressed 9-month timeline. They shifted Rockstar to a highly efficient finished goods model.
And they are investing heavily in Alani New, expanding its physical distribution footprint. So it isn't that they are starved for growth ideas.
No, they're just heavily allocating their operational bandwidth to the acquired brands while the core brand undergoes this painful remodel.
We also have to acknowledge the unsexy, heavily capital-intensive operational investments they're making in the background.
Like a new manufacturing line, right. The CFO noted that their second major manufacturing line in North Carolina is beginning production in the back half of the year.
Yeah, which will provide a full margin benefit in 2027.
Yeah.
They're aggressively advancing vertical integration and direct sourcing to insulate themselves from future commodity shocks.
They even established a dedicated supply chain center of excellence in Dublin to manage global procurement.
And you don't build a supply chain center of excellence in Dublin if you think your core brand is a passing fad.
Exactly. You build that infrastructure to manage a durable, multi-billion-dollar global portfolio over the next decade.
Which is why the buyback can be viewed through a slightly different lens. It isn't necessarily that they lack growth opportunities.
Right. It's that their high margin profile generates so much absolute cash that they can fully fund their domestic manufacturing infrastructure, launch a massive international expansion, and still have hundreds of millions of dollars left over to take advantage of a depressed stock price.
Right. So identifying the problem is step one. We know the symptoms. The SKU rationalization clogged the Pepsi pipeline, paused core innovation, and suppressed wholesale orders.
But as an investor, the most urgent question is always, how long is the recovery going to take? When does the bleeding stop?
And that brings us to management guidance and what they explicitly forecasted for the immediate future.
Yeah, if the market was hoping for a quick V-shaped recovery, well, management delivered a very sobering reality check. They introduced what we are calling the Q3 sidestep.
The Q3 sidestep. The CEO, John Fieldly, stated, "Given that sequencing, we would expect brand Celsius in the third quarter to look a lot like the second quarter before we exit the year back into growth."
And the CFO reiterated this exact phrasing. They are aggressively managing expectations downward.
They explained that the inventory rebalancing with the Pepsi network continued heavily into July. But there is a secondary supply chain maneuver happening in Q3 that is going to inflict further short-term accounting pain.
Right. They are in the process of moving certain SKUs out of their massive mixing centers and pushing them directly into distribution centers to get the product physically closer to the end consumer.
Let's explain the literal architecture of a supply chain here to understand why moving product closer to the consumer actually causes a financial hit on the balance sheet.
Okay.
What is the functional difference between a mixing center and a distribution center?
Well, think of a mixing center as a massive centralized holding pen. It aggregates bulk quantities of various products from different manufacturing plants before customizing them into smaller mixed shipments for different geographic regions.
So product can just sit in a mixing center for weeks.
Exactly. A distribution center, on the other hand, is located much further downstream, directly adjacent to the retail zones. It handles the final rapid deployment of the product to the store shelves.
Moving inventory into distribution centers sounds like an operational victory, right? I mean, faster restocking means fewer empty shelves, which means higher consumer sales, which means higher revenue.
Over a long-term horizon, absolutely. It drastically improves service quality and reduces out of stocks. But in the short term, it creates what the CFO called a one-time timing impact.
How so?
Distribution centers are designed for extreme velocity. They turn inventory over much quicker, which means they physically carry far less total inventory at any given moment compared to a massive mixing center.
Ah, I see. So as Celsius transitions its supply chain to prioritize these high-velocity distribution centers, the total volume of inventory sitting statically in the pipeline shrinks.
And because beverage companies recognize revenue when shipments go into the pipeline, not when they are sold at the register, this strategic reduction in pipeline inventory artificially depresses the reported wholesale revenue for the quarter.
It is the exact same dynamic as the SKU rationalization. They are essentially draining the pipe to make it run faster and more efficiently in the future.
Right, but draining the pipe looks like a massive drop in sales on the income statement. It is short-term accounting pain for long-term operational agility.
But algorithmic trading models despise short-term accounting pain. So I am going to ask the brutal question on behalf of the retail investor holding this stock.
Go for it.
If management is openly broadcasting that Q3 is going to be a written-off transition quarter, a messy sidestep filled with supply chain friction, why shouldn't investors just dump the stock right now, take the tax loss harvesting, and wait until 2027 to even consider this company again?
Honestly, it is a highly logical reaction. However, we have to respect how financial markets operate.
Meaning they're forward-looking.
Exactly. The stock market is a forward-looking discounting mechanism. The absolute moment the CEO utters the words Q3 will look like Q2, the institutional analysts update their models.
The algorithmic traders execute their short positions, and the stock is instantly repriced to reflect that bleak reality. The stock just gets thrown into the penalty box.
Yeah, the sidestep of Q3 is theoretically completely baked into the current share price. The market has severely punished the valuation for this logistical stumble.
So the inherent risk of capitulating and selling your shares right now is that you are selling at the point of maximum pessimism.
Right, because if that consumer scanner data remains stable-like, if actual human beings continue buying the product at the register, the moment those warehouse clogs clear and the pipeline normalizes, the wholesale revenue numbers could violently snap back to match the actual consumer demand.
And if you sell now, you completely miss the snapback. So assuming the bad news is thoroughly priced in, we need to analyze what specific catalyst could drive the stock out of the penalty box and trigger that snapback.
And management was very eager to pivot the conversation toward their 2027 innovation pipeline.
So what is the structural catalyst they believe will allow them to exit the year back into growth?
For the core Celsius brand, the single biggest catalyst they pointed to is the launch of a new 16-ounce can line coming in early 2027.
Okay, let's talk about form factor for a second, because in the energy drink wars, the physical size of the can is a massive, highly contested strategic battlefield.
Oh, absolutely. Celsius historically dominated the slim 12-ounce can market. That sleek profile is what appealed to the yoga studios and the fitness demographic.
Right, it felt like a premium health supplement, not a massive, aggressive dose of liquid caffeine.
But the legacy titans of the category, Monster, Rockstar, and the newer aggressive challenger brands like Ghost and C4, have deeply conditioned a massive segment of the market to expect a 16-ounce can.
Particularly the male demographic and the blue-collar convenience store consumer. For them, it is a pure value proposition. You get more liquid and a higher caffeine payload for roughly the same price.
And the CEO, John Fieldly, openly admitted on the call that their current 16-ounce offering is one area of weakness. They simply have not penetrated that high-volume, high-caffeine segment of the market effectively.
Yeah, their early attempts at 16-ounce cans kind of felt like an afterthought.
So by launching a highly engineered, meaningful innovation against the 16-ounce category in early 2027, they're stepping directly into the cage match with their largest competitors.
It is a massive white space opportunity, but it carries immense execution risk. If they get the flavor profile or the branding wrong, it will be a very costly failure.
Furthermore, they noted that the Fizz-Free line, their non-carbonated offering, is showing tremendous organic momentum, with dollar sales up over 20% sequentially in the second quarter.
Yeah, they are officially elevating Fizz-Free from a niche offering to a core subline. And it makes complete sense. A massive segment of the fitness demographic does not want heavy carbonation sitting in their stomach immediately before a high-intensity workout or a morning run.
Exactly. So the core brand gets a 16-ounce offensive weapon and a Fizz-Free expansion.
But what about the current savior of the balance sheet? What is the catalyst for Alani Nu? Because they cannot afford to wait until 2027 to keep that momentum going.
For Alani Nu, the catalyst is immediate, and it revolves entirely around their limited time offer, or LTO, strategy. Management heavily teased their upcoming Q4 launch, a highly conceptual flavor called Witch's Brew.
Witch's Brew. I mean, it sounds perfectly calibrated for a viral TikTok moment. It is engineered for the aesthetic of social media.
Management confidently stated that they project Witch's Brew to be their biggest limited time offer in the brand's entire history.
Let's analyze the mechanics of an LTO strategy because it is a very specific high-wire playbook in consumer packaged goods. When you launch a wild, limited-time flavor like purple cotton candy, which they mentioned recently became their top-selling new SKU or cherry slush, you aren't just trying to sell a few extra cans.
Right. What is the deeper psychological goal of an LTO?
Exactly.
Well, an LTO is fundamentally a customer acquisition mechanism. It operates on the psychology of artificial scarcity and urgency.
The consumer is walking down the beverage aisle, surrounded by hundreds of static options. They see a crazy, brightly colored new flavor, and they know it won't be on the shelf next month.
Yeah, it drives immediate impulse trial. They buy it simply to see what it tastes like or to post a review on social media.
It cuts through the visual noise of the retail cooler. You might ignore the standard flavors you have seen 100 times, but a neon can of Witch's Brew disrupts your normal shopping pattern.
And once they secure that initial trial, the strategy relies entirely on the underlying quality of the liquid to convert that impulse buy into habitual repeat behavior.
Right. And management specifically noted that these LTOs are successfully bringing entirely new demographics into the Alani brand ecosystem. And crucially, they're tracking very strong repeat purchase metrics.
But, and this is vital, they do not want to live and die by the LTO sword. The ultimate strategic goal is to graduate the top-performing, highly viral LTO flavors into the permanent, everyday core rotation.
It is a massive, decentralized audition process. You run 5 highly experimental flavors for a limited time, you let the market decide which one goes crazy, and then you quietly slide the winner into the permanent, everyday lineup.
You are essentially tricking the consumer into discovering their new permanent daily beverage. It adds necessary stability and predictability to the revenue stream.
And the CFO noted that as they successfully build out this base portfolio of permanent core SKUs, the LTOs will eventually become less relevant to the total top-line revenue, acting more as seasonal marketing activations rather than the primary revenue driver.
And that is a critical transition to monitor. Because if Alani Nu fails to build that durable, permanent core, and they become utterly reliant on having to invent a viral, gimmicky hit every 3 months just to keep the revenue numbers up, well, that is an exhausting and highly volatile business model.
The moment an LTO misses the mark, the revenue crashes.
Which is exactly why the physical integration into the Pepsi DSD network was so vital for the long-term survival of Alani Nu.
Yeah, the CFO emphatically stated, the integration into the Pepsi DSD system is complete and it is working.
They have the massive, highly efficient distribution plumbing fully installed. Now they just need to flow the right mix of LTOs and permanent core flavors through those pipes.
Okay, so we have covered the messy core brand recovery and the Alani Nu growth engine. But there was one more piece of management guidance that felt incredibly ambitious, and it points to a much longer-term horizon.
Yes, they laid out a massive 5-year roadmap focused heavily on international expansion.
Management believes that international markets represent their largest structural white space opportunity.
Currently, both Celsius and Alani Nu are significantly underpenetrated on a global scale, and they attached a very specific, aggressive metric to this vision.
The CEO stated that over the next 5 years, they expect international markets to represent more than 15% of their total portfolio revenue.
For a company currently doing over $800 million a quarter primarily in North America, scaling international operations to 15% of the total pie requires generating hundreds of millions of dollars in new overseas revenue.
It is a massive logistical undertaking, and they pointed to a very specific blueprint for what success looks like in these foreign markets. Yeah, Sweden, which feels like a very random market for a Florida-based energy drink company to highlight. Why is Sweden the golden child for Celsius?
Well, Sweden is actually one of their longest-standing, most mature international markets. They have been quietly building consumer loyalty and distribution density there over a significant period of time.
And the results of that compounding effort are staggering. This quarter, the team in Sweden delivered the highest 4-week sell-through in market history, with nearly 3.5 million units purchased by consumers.
3.5 million units sold in a single month, in a country with a total population of roughly 10 million people. That implies an incredibly deep level of market penetration and habitual consumption.
It demonstrates exactly what strong, localized execution and durable consumer loyalty can achieve when a market reaches full maturity.
And management stated this is the precise blueprint they are actively deploying in every new global market they enter. They are avoiding the scattershot approach.
Right. They are focusing on highly disciplined launch plans and establishing strong local partnerships. Partnerships like the one they highlighted with Suntory in their newer European markets.
This is a crucial strategy. You do not try to build a direct-to-store delivery network from scratch in a foreign country.
No. The capital expenditure would destroy your balance sheet. You partner with a localized giant who already owns the delivery trucks, the warehouse infrastructure, and the deep relationships with the grocery store buyers.
Furthermore, they are taking this international infrastructure they are painstakingly building for the core Celsius brand, and they are preparing to run Alani Nu through those exact same pipes.
The CEO noted they are currently identifying select international markets to introduce Alani Nu for the very first time in 2027.
That is the ultimate financial synergy of a portfolio company. You bear the agonizing cost, complexity, and friction of building a global supply chain once, and then you leverage it by running multiple high-margin brands through it, multiplying your return on invested capital.
And this seamlessly ties back to that supply chain center of excellence in Dublin we discussed earlier. They are centralizing their global procurement and operational logistics to execute this 5-year roadmap with maximum efficiency.
It is a compelling, highly ambitious long-term vision. But as an investor, you do not live in 2027. You live in the present.
Yeah, you have to survive the agonizing volatility of Q3 to reach that promised land. So let's synthesize all of this complex data, all of these narratives, and all of these operational hiccups. Let's deliver the bottom line.
Okay, the synthesis requires holding two highly opposing ideas in your head simultaneously.
The short-term signal for Celsius Holdings is undeniably heavily bearish.
The operational disruption from the SKU rationalization was significantly deeper and more painful than management anticipated. The physical inventory clog in the Pepsi DSD system is going to severely suppress reported wholesale revenue through the third quarter.
And the margins are under heavy pressure from macro commodity inflation and the necessary capital-intensive transition to a trench warfare operational model.
If you are looking for immediate gratification or a sudden pop in the stock price over the next 3 months, this earnings call definitively proved that it is not coming.
But the long-term signal is cautiously structurally bullish.
Right. When you look past the temporary wholesale shipment disruption and focus intently on the retail scanner data, actual consumer demand for the core brand remains remarkably stable.
Down only 2% amidst a massive, highly disruptive operational overhaul. And the portfolio acquisition strategy is yielding spectacular immediate results, with Alani Nu providing a billion-dollar revenue engine that completely alters and expands the demographic reach of the entire company.
Plus, the complex physical integration of Rockstar and Alani into the Pepsi DSD network is officially complete, permanently removing a massive source of future logistical friction.
And underlying all of this, the core business model is generating enough free cash flow to confidently buy back $100 million in stock, while simultaneously funding aggressive international expansion and a new domestic manufacturing facility.
So let's make this highly actionable. Let's speak directly to you, the listener, based on your current portfolio position.
Yeah. If you are an investor currently holding the stock, sitting on paper losses, what is the play?
This position requires extreme disciplined patience. You have to intellectually recognize that the core brand is undergoing a very messy, highly public remodel.
You do not sell your house at a massive discount just because the kitchen is currently torn up, the plumbing is disconnected, and there is dust everywhere, assuming you believe the contractor has a solid blueprint for the finished product.
Exactly. The underlying consumer metric, the 2% scanner data, suggests the brand health is largely intact. But the financial statements are going to look incredibly ugly until the physical supply chain plumbing is fully reconnected.
You hold your position and you monitor that scanner data obsessively in the coming quarters to ensure that 2% decline does not suddenly accelerate into a broader consumer rejection of the brand.
But what if you are the investor sitting on the sidelines looking at a stock that has taken an absolute beating from its all-time highs and wondering if this operational stumble has created a generational buying opportunity? Do you rush in and buy the dip right now?
The structural data suggests you do not rush in. The management team just explicitly, publicly warned Wall Street that Q3 is going to be a messy sidestep.
And financial markets are deeply emotional and highly reactive. When a former hypergrowth darling inevitably posts a second consecutive quarter of stagnant or declining core revenue in Q3, the algorithmic reaction and institutional sell-off could be brutal.
So you wait. Allow the forecasted Q3 weakness to fully manifest on the balance sheet. See if it triggers another massive market overreaction and a further collapse in the share price.
That potential dip could offer a significantly better, highly de-risked entry point before the massive 2027 innovation cycle, the 16-ounce line, and the international Alani Nu launches actually kicks into gear.
We didn't just read the top-line revenue today. We traced the physical path of a can of Celsius from a volatile aluminum futures contract through a clogged distributor warehouse and onto a highly contested retail shelf to understand exactly why the numbers look the way they did.
Because that is where the truth always lives in corporate finance. Not in the polished headline of a press release, but in the gritty operational mechanics beneath it.
As we wrap up this deep dive, I want to leave you with one final, highly provocative thought to mull over. Something that wasn't explicitly debated on the call, but is deeply implied by the rapidly shifting architecture of this entire company.
Okay, let's hear it.
We watched Celsius explode into a massive, multi-billion-dollar valuation based purely on the phenomenal, unprecedented success of a single functional energy drink. But today, they revealed that the core brand shrank by 12%.
Right, and the only thing keeping the total company growing at 11% was a massive, highly viral, billion-dollar hit from a completely separate, acquired brand, Alani Nu.
It structurally shifts the entire investment thesis of the company, from a singular hypergrowth engine to a diversified portfolio manager.
Which is a profound change.
So here is the question you need to ask yourself as you analyze the broader beverage sector. If it now requires spending hundreds of millions of dollars to acquire and bolt on a completely separate, hyper-viral brand just to keep Celsius Holdings' total top-line revenue creeping upward at a pedestrian 11%, has the standalone functional energy drink fad officially hit its absolute ceiling in the United States market?
Are we witnessing the death of the singular hypergrowth beverage brand and the necessary, highly painful birth of a diversified conglomerate?
Because if the ceiling has truly been hit, the massive valuation multiples of the past are never, ever coming back.
That is the harsh structural reality that every growth investor must eventually confront when a market matures.
And confronting those complex realities is exactly why we do this. Thank you for joining us on this Talk Tickers Deep Dive. Keep your portfolio smart, keep your analysis sharp, and we will catch you next time.